begin with breaking news out of the White House, where U.S. President Donald Trump has signed tariffs on imports.
Where the self-imposed deadline.
Mexico has just taken a drastic step that could send shockwaves through the entire U.S. auto industry in response to newly elected U.S. President Donald Trump's announcement of aggressive tariffs on Mexican imports. In a bold and calculated countermove, the Mexican government has cut off the export of critical auto parts to the United States, a decision that threatens to bring America's finely tuned car production system to an abrupt and costly halt. This is not an impulsive reaction, but a deliberate strategy aimed at exploiting the U.S. auto industry's deep reliance on cross-border supply chains that have evolved over decades. For years, American automakers like Ford, General Motors, Stellantis, and newer players like Tesla and Rivian have depended heavily on Mexican factories to produce essential components such as transmissions, wiring harnesses, engine assemblies, and specialized electronics. Mexico's combination of lower labor costs, proximity, and established expertise turned it into an indispensable partner, with hundreds of trucks carrying these vital parts crossing the border daily to keep assembly plants in Michigan, Ohio, Kentucky, and elsewhere running smoothly. Trump's tariffs, meant to pressure Mexico into renegotiating trade terms favorable to the United States, have triggered a response that could backfire dramatically. By targeting auto parts, one of the pillars of U.S. manufacturing and a sector that cannot quickly shift to alternative suppliers, Mexico has ensured that the impact will be immediate and severe. Factories built around just-in-time inventory systems now face the very real prospect of production lines going dark as parts stop arriving. Automakers, already dealing with pandemic-era disruptions and semiconductor shortages, now scramble to find replacements for highly specialized components that often cannot be sourced elsewhere in North America. Within days, vehicle production could slow to a crawl or stop entirely, leading to layoffs, furloughs, and deep uncertainty for thousands of workers whose livelihoods hinge on the steady flow of parts across the border. Dealerships, too, find themselves on the front lines of this crisis. With inventories already thin, the sudden halt in new vehicle deliveries pushes prices on new and used cars, already at historic highs, even higher, pricing out many consumers and undermining sales. Rental car companies, fleet buyers, and rideshare services face similar shortages, rippling the effects across sectors dependent on a steady supply of vehicles. Meanwhile, financial markets react with alarm. Automaker stock prices plunge, as do shares and parts suppliers, logistics firms, and industries closely tied to car manufacturing such as steel, aluminum, and electronics. Investors, wary of prolonged trade conflict and supply chain volatility, pull back, triggering broader market uncertainty and fears of a wider economic downturn. The stakes are even higher politically. Trump's tariffs were pitched as a way to protect American jobs and manufacturing strength, but Mexico's swift and strategic retaliation puts American auto workers and their communities in harm's way. States like Michigan and Ohio, which form the industrial backbone of U.S. car production and where many voters supported Trump's trade policies, now face the specter of mass layoffs and economic instability. Unions and industry leaders quickly demand a reversal of policy, while the administration faces mounting pressure to choose between escalating the standoff, which risks deepening the economic pain, or seeking a face-saving diplomatic off-ramp. Beyond the immediate disruptions, the long-term consequences of this standoff threaten to reshape the entire North American auto industry. Automakers weigh shifting production to domestic factories or new international locations like Canada or Asia, but such changes require years and billions of dollars in investment, as well as rebuilding highly specialized supply networks. Many of Mexico's suppliers produce parts and systems that simply don't exist elsewhere on the continent, making quick relocation impossible. Even if companies manage to find stopgap solutions, the trust and stability that once defined U.S.-Mexico trade relations have been fractured, and rebuilding them will not come easily. For Mexico, the risks are significant, as its economy remains heavily reliant on exports to the United States. Yet in recent years, Mexico has quietly diversified its trade relationships, forging deeper economic ties with China, the European Union, and South America. This diversification gives Mexico a resilience it lacked in previous trade conflicts and strengthens its hand in negotiations. The United States, by contrast, faces a much steeper challenge in trying to reconfigure a supply chain so deeply integrated with Mexico's manufacturing base. The ripple effects extend far beyond cars and trucks. Other U.S. industries dependent on cross-border trade, such as agriculture, consumer electronics, and heavy equipment, fear that they could be next if the trade war escalates. American farmers, already under pressure from past tariff battles, now worry about potential retaliatory measures on billions of dollars worth of produce shipped to Mexico. Retailers, still struggling to stabilize after years of pandemic disruptions, face new headaches as rising car prices and economic uncertainty reduce consumer spending on other goods. Credit markets tighten, and banks reconsider loans to businesses tied to the auto sector, amplifying the strain on small and medium-sized enterprises. Meanwhile, the geopolitical dimension of Mexico's counterstrike cannot be ignored. Other countries watch closely as Mexico challenges U.S. trade pressure, seeing an example of how targeted retaliation can reshape negotiations with Washington. China, in particular, may draw lessons from Mexico's approach as it navigates its own complex trade relationship with the U.S. The broader effect could be a weakening of America's long-standing dominance in trade policy, as more nations feel emboldened to push back against protectionist measures. Behind closed doors, diplomatic efforts race against time. Negotiators on both sides explore compromises that might offer a path forward, perhaps a temporary suspension of tariffs or narrowly tailored exemptions for critical components. But finding common ground is politically fraught. Mexico seeks guarantees that it won't face similar trade coercion in the future, while the U.S. administration fears that backing down could be seen as a political defeat. The resulting stalemate deepens the crisis, prolonging economic pain for businesses and workers alike. In the meantime, automakers and parts suppliers confront painful decisions. Some accelerate plans to nearshore production within the U.S., despite the massive investment and time required. Others look abroad for alternative sources, often at significantly higher cost, threatening profitability and, ultimately, competitiveness. As plants idle and workers face layoffs, communities built around auto manufacturing brace for economic hardship that could last well beyond the resolution of this dispute. Wall Street continues to react with volatility, with stock prices for automakers, suppliers, and related industries swinging wildly amid the uncertainty. Investors fear not just the immediate losses but the possibility of a permanent shift in the global auto landscape if production remains constrained or if U.S. companies lose market share to international rivals. The economic cost is counted not only in billions of dollars of lost output, but in shaken confidence that could slow investment and innovation for years. For millions of American workers, factory employees, engineers, logistics managers, and dealership staff, the crisis brings daily anxiety. Their livelihoods depend on decisions made in political backrooms, far from the assembly lines and office floors where the economic consequences will ultimately be felt. Consumers, too, face difficult choices as soaring prices and limited availability force many to delay or abandon plans to buy new vehicles, deepening the demand shock. In the bigger picture, Mexico's move has laid bare the fragility of globalization's most successful trade networks. What took decades to build, highly efficient, cross-border supply chains optimized for cost and speed, can be threatened overnight by political conflict. And while policymakers may hope to contain the fallout to the auto industry, the reality is that every interconnected sector of the North American economy now stands on edge. As the days pass and the standoff remains unresolved, the urgency to act becomes undeniable. Both governments face a stark choice: escalate further and risk a trade war with cascading damage across industries, or seek compromise before the economic harm becomes irreversible. Whatever path is chosen, the shock from Mexico's countermeasure is already reverberating, challenging assumptions about the permanence of global supply chains, redrawing lines of economic power in North America, and forcing an industry that helped define American prosperity to confront an uncertain future it can neither fully control nor predict. On the political stage, the auto industry erupts into a central issue dominating national discourse: as lawmakers, particularly those from states whose economies hinge on car manufacturing, demand swift action to end a crisis that is spiraling beyond anyone's early predictions. Some call urgently for rolling back the tariffs that ignited the trade conflict, hoping to restore fragile supply chains and stabilize production, while others argue for doubling down with aggressive retaliatory measures against Mexico, exposing deep ideological rifts within the U.S. government between economic pragmatism and nationalist trade policies. As weeks pass without resolution, the stakes rise exponentially. Billions of dollars in production losses mount, hundreds of thousands of American jobs hang in the balance, and the very viability of an auto sector built on cross-border supply chains faces unprecedented doubt. Mexico, through its calculated counterstrike, has demonstrated just how indispensable its manufacturing sector is to North American trade, forcing Washington to confront the real limits of unilateral economic pressure. The deepening crisis doesn't just reveal the fragility of just-in-time manufacturing, but ignites a broader debate about globalization, economic sovereignty, and the unforeseen consequences of protectionism. Automakers, who spent decades perfecting intricate supply networks that sprawl across borders, now confront the grim reality that these networks can be frozen overnight by political decisions. Calls to reshore production run up against practical barriers. The staggering cost and years of planning needed to build and staff new factories, recreate specialized expertise, and rewire logistics. Meanwhile, the immediate toll grows more severe. Tens of thousands of American workers are furloughed or laid off, facing prolonged uncertainty, and what once seemed like a short-term policy gamble now looks like a structural crisis. Unlike past downturns driven by market forces, this disaster is entirely policy-driven, fueling frustration and protest from unions and workers in industrial cities like Detroit, Toledo, and Louisville who demand the government reverse course before the damage becomes permanent. Across the border, Mexico feels pressure too, especially in regions like Monterrey and Puebla that anchor its auto parts industry. Yet thanks to strategic foresight, Mexico mitigates the shock better than anticipated. Even before Trump's tariffs, Mexican officials quietly deepened trade ties with European and Asian manufacturers seeking new supplies outside the U.S. In a striking twist, automakers from Germany, South Korea, and Japan snap up Mexican-made components, softening Mexico's economic blow and signaling a shift that could permanently diversify Mexico's customer base beyond its northern neighbor. This realignment upends the long-standing perception of Mexico as merely a junior partner in North American trade, asserting its role as an independent manufacturing powerhouse and exposing the limits of Washington's leverage, a shift few in the U.S. anticipated. In Washington, the political debate fractures further. Hardline trade hawks argue Mexico's defiance warrants an even tougher response, from broader tariffs to threats of withdrawing from trade agreements, but face pushback from business leaders, economists, and even some within the administration who warn of escalating economic self-destruction. Treasury officials and trade advisors connected to the auto industry advocate de-escalation, arguing that protracted conflict will only drive automakers to invest elsewhere, undermining American manufacturing in the very name of protecting it. Trapped between the political cost of appearing to back down and the economic reality of deepening losses, the White House struggles to chart a path that avoids disaster without looking weak. Meanwhile, the crisis reshapes American consumer behavior in real time. With production throttled, Americans hold on to aging cars longer, pushing record demand to repair shops and mechanics. Rental car companies, unable to replace vehicles, extend fleet lifespans beyond intended years, leading to higher maintenance costs and thinning inventories. Used car prices, which had been easing post-pandemic, surge once again, pricing out many buyers and squeezing household budgets. Beyond consumers, the pain radiates outward. Trucking firms, steel producers, electronic suppliers, and port operators all grapple with the sudden slowdown in cross-border trade. International players, too, enter the fray. European car makers like Volkswagen and BMW, who rely on Mexican parts for North American assembly, pressure diplomats to intervene to restore stability. Canada, whose auto sector is deeply tied to both the U.S. and Mexico, offers to mediate. Yet the entrenched positions on both sides Mexico seeking meaningful concessions and the U.S. struggling to protect its protectionist narrative make compromise elusive. In a twist of irony, the crisis accelerates investment in automation. Faced with the risks of political disruption, automakers invest more heavily in robotics and AI, aiming to reduce dependence on cross-border human labor. The paradox becomes clear. Trade policies meant to protect American manufacturing jobs may, in the end, hasten their disappearance. As economists and analysts unpack the deeper implications, it becomes undeniable that this is no longer just about tariffs or auto parts. It is about the peril of trying to untangle decades of economic interdependence overnight. The global economy, built on complex webs of mutual reliance, resists simple nationalist fixes and attempts to impose them risk systemic chaos. Diplomatic back channels race to broker an off-ramp as corporate leaders, unions, and international partners warn of lasting scars. Mexico, having exposed its pivotal role, signals willingness to negotiate, but on terms that reflect its newfound leverage. Inside the U.S., political leaders face a reckoning, continue down a path that could cripple the auto industry, or concede to reality and seek cooperation over confrontation. The auto industry, once the symbol of American industrial might, now finds itself an epicenter of a crisis that questions the very logic of modern trade policy. Across North America, policymakers, automakers, and consumers wait to see if this standoff will be resolved before the damage hardens into permanence. Beyond North America, countries from Southeast Asia to Eastern Europe position themselves as future manufacturing hubs as multinational corporations scramble to diversify risk. Mexico, once economically tethered to the U.S., emerges from this crisis as a more globally integrated actor, better able to resist future American trade pressure. The lesson is stark. Supply chains are the new battlegrounds of economic power, and disruption, not weapons, is the tool that shifts global influence. As vehicle prices climb, investor confidence falters, and diplomatic urgency peaks, the world watches a defining chapter unfold. Mexico's move has challenged U.S. dominance in trade, rewritten the calculus for automakers, and reshaped the geopolitical balance in North America. Even if peace is brokered, the scars will remain. Automakers will rethink supply strategies, governments will tread more cautiously in trade conflicts, and consumers will live with the economic aftershocks for years to come. The once rock-solid foundation of North American auto production has cracked, and through that fracture, the fragile reality of globalization stands revealed, changing the rules of trade not just for today, but for decades ahead.